Welcome back to the channel. I'm Ozbourne Foreman, and today we're going to be talking about the Bank of England raising interest rates. We've got Argo Blockchain, Cineworld, Games Workshop, Deliveroo, Fevertree and Ocado. These are the companies that will be at discussion in this video of the UK stocks that I'm buying right now. So if you like the video, please put one of these to help beat that YouTube algorithm, and let's keep it as short and succinct as possible. So first things first, let's take a look at the portfolio, which this week, yet again, I have outperformed. I've done very, very well this week, although for some reason it's not updating very well. Boohoo did actually close at a price of 99 pence and 16. So hopefully when I refresh this, it should work, although at the moment it doesn't seem like it wants to refresh at all. But yes, it did close at that, and unfortunately I don't know why it's playing me about here, but it did end the week up about 9.53%, which was marginally above that of the Nasdaq, although the Nasdaq is still open as of recording. Unfortunately, you do have to trust my word on this, but I'm sure if you Google Boohoo share price, you will see that the uncrossed trade on that was obviously that mentioned price. Either way, it's still a significant figure to be up of and is a promising sign overall. And I think overall we're going to have momentum now. Things might be trending upwards. You may go, well, there's so much fear, there's a potential recession, there's all of this information, but I don't care. That's macroeconomics. It's out of my control. Can I control what's going on in Eastern Europe? Absolutely not. Can I control inflation? No. Then why worry about it? I think there's a point of dedicating your energy and everything you focus on, and if it's out of your control, then don't even concern yourself with those types of issues. So therefore, my portfolio has done quite well so far. I did end up buying some shares of Boohoo this week as well. I think I bought another additional 144 shares, and I managed to buy it at roughly 86 pence, which was the low of the week, and I was quite happy with that, but ultimately it's short term, and now shares are just pushing 100 pence. See, now you can see this here, see how it has updated my performance for the week being up 9.65%. That's fortunate that it did update in time, although year to date I'm still down 19.37% or 4 grand. In 711 days I'm down £11,738 or 38%. However, I know that I'm going to be making money. I'm going to deposit this money into my portfolio, and over time we're going to see this grow together. And unfortunately, if you don't like that I'm confident in that regard, well, it is what it is. I'm going to remain as humble as I possibly can be, because what I have noticed in this niche is a lot of people build egos. They get a certain amount of finances in check, or they see their investments go up by a certain amount, and then suddenly they think they're better than everyone else. So I think that's a very important thing to obviously not end up doing. But again, I'm going to try my best, because ultimately I'm only human. So the news this week, we have got the Bank of England raising interest rates as inflation soars. Now, they've raised their interest rates to 0.75%. This means obviously money is therefore more expensive to accrue, and therefore obviously we're hoping to see less spending, which will therefore pull down inflation, and that is very much in a very simplified manner. So it's natural that they're going to be doing this, although they're reacting quite slowly. They've mentioned that due to the Eastern European conflicts that they now expect inflation to be around 10% this year, and therefore by raising interest rates to 0.75%, that's going to be somewhat effective. I am obviously taking it with a grain of salt. I don't think this is primarily Eastern Europe. There's been a lot of warnings on the dependence of energy on, for instance, the likes of Russia. But again, that's more political debates. I think ultimately it's a bit misleading. But if inflation is going to hit double digits, it is what it is. And it's best to keep investing in productive assets, assets that are generating returns on it. You might go, well, an inflation hedge is gold. And I'd be like, well, actually, I disagree. Yes, it can hold its value against inflation and over time. And it's probably better than holding cash. It's not a productive asset. It doesn't produce any value whilst holding it. It's not a business that's growing on their finances each year, or it's not a company that's paying out a dividend regularly from the spare cash flow of their profits. And so obviously, again, I become quite averse. But a raise in interest rates is obviously something that is going to tighten the markets, and I think this was expected, as we definitely saw obviously the stock market rise, especially in America, where they had their first interest rate raise to 0.25%, even though it's such a small amount comparing the idea of inflation being around 6.8%. They sort of unlocked the markets a little bit here, where in a way it was already priced in, and now that it's happening, investors are sort of more eased, they're more happier, they're like, okay, at least inflation is now being dealt with and combated, so we'll see how things go. And that there very much seems to be how the markets are at the moment. And I suppose when we look at things like Boohoo, here we can see that actually rising inflation could be a concern, but we're seeing more or less things ease as interest rates rise. In fact, the reason why Boohoo had such a good performance one of these days is because China had Shenzhen, one of their major distributing ports, in lockdown, which means their competition such as Shein is obviously not going to be able to compete as well, and that eased some of the competition concerns, and it's been flying up in the last week so far. And I mean, the last 2 weeks it's gone from 60 pence to nearly £1 per share, but I digress. So the first item of news this week is Argo Blockchain yet again, but I will not let it drag on too long. They've had a fleet swap agreement with Core Scientific for S19J Pro machines. Effectively, they didn't have the Pro series of this or the J variant before, and so obviously they're swapping this out. You might go, what's the point of that? That's ridiculous. Why even bother? Well, it's a little bit interesting on their justification of this. Firstly, we need to acknowledge that it represents 60% of their total mining capacity, but in order to mitigate the downtime, they're obviously doing it partially at different points in time, and they expect to do this through May and July of 2022. So what they'll do is they'll move a few, then get them running, move a few, get them running, so they don't see too much downtime. Furthermore, they are saying that actually that they're going to do this so that they want to own all of their Bitcoin miners, and they're using that path, and it is with the final step towards their strategic objective of owning and operating all of our miners. So obviously it's partially that, and it allows them here. Obviously they return the old machines, it lowers operational expenses, but what they can do with this is they can move some of their fleet that was under a third party. So let's have a look. I need to just double check this. Where are we? The agreement will mean that the company also avoids the logistical challenge and downtime associated with relocating its existing machines hosted by Core to its Helios site. So it allows them to move them off-site very easily and little to no concern. So obviously they can get up and running and such. It doesn't say any financial things in here, which is a little bit annoying, and ultimately the change of capacity really isn't big at all, changing from 967 petahash per second being what it is now, and it was, well no sorry, the other way around, being is what it will be after this transfer, compared to 958 petahash a second. So again, it's not a massive move, but something to keep in mind. Again, I'm not a fan overall, but if this lowers their depreciation, which I doubt, because this is likely going to be a more modern machine. I haven't done the research here. This modern machine is likely going to depreciate at a faster value, adding to obviously their problems where they need cash alongside their debt. The next company on the list this week is actually Cineworld Group. Now, Cineworld is something I can't resist but to not follow. It's such a fascinating company, and it's like, hang on a minute, I can't see this possibly going well in any way, shape, or form, yet here it still stands, and it is such a fascinating case study for myself. Right, so firstly, I'm going to skip all of this. Jumping to their debt and cash position, right? Their net debt increased by $492.7 million from $4.3 billion to $4.8 billion. Now, you need to remember that the market capitalization of this company is a fraction of this. In fact, if I type in Cineworld share price or that, I'm going to have to cover that for location, they have a market capitalization of £500 million. When you compare that to the amount of debt they have, that is absolutely ridiculous, but also very amusing as well. But they have seen quite a bounce back and a form of recovery. You look at obviously versus their 2021 versus 2020, they've had some high impressive percentage figures, but again, they're including lockdown. So I would rather be comparing that to 2 or 3 years ago before the pandemic to really get a detailed vision on how they are doing. But it does seem that this might not be something that's going away as soon as everyone anticipated. And in fact, I'm quite interested in more of a speculative play to keep an eye on this kind of company, because they are actually doing quite well. Who would have anticipated that they will now have a revenue of about £1.8 million, sorry, £1.8 billion or dollars even, compared to the year before being almost more than half that. That is quite impressive for a company that you think, okay, they just have, screens located globally across the world, and this is something that is getting competed with the likes of these online forms of media entertainment such as Netflix, Disney+, HBO Max, Apple TV, Amazon Prime. There's so much competition in this industry, it's almost unfeasible to think, can they really survive? But yet, here they are, and they still stand. They do also have their damages to Cineplex. Now, this was an acquisition that I believe that they were going to go through with, and they wrote a clause which meant, obviously, if they backed out of this, then they owed Cineplex a certain sum of money. And no, naturally, the group disagrees with the decision, but they are justified to pay out Canadian dollars of $1.23 billion in damages to Cineplex. So again, not only have they got that net debt being nearly $4.8 billion, they've also got this problem, which is going to add another 1.23 billion Canadian dollars to that. Again, the things don't look positive for this company, but they still stand, and it is very interesting to me. And obviously, they've got a loss after tax of about $565 million, and it'd be interesting to see how this goes, because this might be a company that recovers, but it's well out of what I would look at, but it is a simple business. So do we see cinemas increasing in the future? Do you think people are going to return to go to them? Are they going to adjust to have a more premium market? Are we going to see companies like Cineworld tailor for those with more the experience? You go there, you get the reclining seats that vibrate, whatever you want, you've got popcorn, you've got high quality service. Does this turn into more of a restaurant hybrid, or what do we see here? Or does it become so cheap that it therefore outcompetes those online brands, which I think is very unlikely? So what do you think will happen to Cineworld? Please leave a comment down below in the comments section. The next company in mind is Games Workshop. Now, this is my second largest holding in the portfolio. If we have a quick look at my portfolio, we can see here that I hold 77 shares. I've not actually averaged down since the decline, but they've recovered quite well in the last week. We can see here that I have 77 shares worth approximately £5,600, and ultimately it's not doing too well with performance, but I've earned about £240 in dividends. It holds about 30.1% of my portfolio, and let's just say it was quite needed when Boohoo was on a savage decline, and ultimately still is, as it's down about 3 to 4 times below from the current price to where its all-time high is. Was. So, Games Workshop has seen Baillie Gifford, I don't know if I'm saying that correctly, but a very, very large company, and they have actually doubled their position size. Now, obviously, this gets a little bit complicated because I do believe they have their own funds and options, so this means that these funds obviously are going to change as customer inflows and outflows occur, but it's very promising to see that they did have a stake of about 5.02%, and it's now a stake of 10.04%, so it's literally a double in the position size, and very bullish for the company. There we are, we're getting institutional investors hold a much greater stake in the company, which suggests that they are confident in the future outlooks. I do believe Baillie Gifford does have a fund. Is it a Buffettology fund or a UK fixed investment equity fund, which I'm saying a lot of words here, but effectively I think they had a UK fund that did have some investments in Games Workshop, and that may be why, but it is promising to see in this outflow of money from the markets that their position size in Games Workshop is actually increasing, and I think overall that's a positive sign. It's a quality company, something I've not been buying lately because I still can't fully wrap my head around some of the Warhammer 40k stuff, and obviously there was a lot of concerns with the animators and what they were doing amongst the community, and so obviously I've been a bit hesitant buying more, and ultimately when you've got Boohoo that has dropped such an extreme amount in the last year, I felt right now I need to be putting my money into that. It's much greater value, there's more deep value there, and therefore I've been putting that money in and really focusing elsewhere with my attention. But hopefully once Boohoo starts to recover, or at least it pushes beyond the point where I see there's little to no value in buying more, hopefully if Games Workshop is still down, I'll be buying a lot more, diversifying the portfolio, because I hold about 30% Games Workshop now and about 69 to 70% worth of Boohoo, so that we need to keep in mind. Deliveroo. Now this is something I wanted to add because I've not really commentated on this, but it's an exciting recent IPO and a company that pretty much everyone experiences in the UK, as far as I'm aware. I mean, I don't do deliveries or takeaways. I don't actually order that form of food. And I think the last time I had it was a one-off about half a year ago. It's just not something that I'm personally into, but I can see the hype behind it. And I know that if I was drinking it at the house, I'd think, yeah, I'd love a takeaway pizza or something like that. But that's why I don't do that, and it's self-control. Regardless, they've seen their gross transactional value, so I'm guessing the overall amount of the transactions in a basket, but I would need to know more on that, up 70% year on year in a constant currency basis, so assuming that the currency, the exchange rates were actually the same. They've had further UK market share gains. They have also grown their, obviously, population coverage to 77% from 53% in the last year. And I did like to see here that their revenues are up 57%, which is primarily due to the GTV, gross transactional value, that we spoke about earlier. But they have a cash and cash equivalents of £1.3 billion, which is a very, very strong spot to be in. And I do think I remember seeing below somewhere that they mentioned that they actually had no debt. I can't see it at the moment, but it will be somewhere on the screen as far as I'm aware. I suppose, hold where are we? I'm not looking at this properly. But effectively, they did say that they had no debt, and I thought that was quite impressive. And if you think that this company is going to be growing in the future, so then it seems quite promising. But then is it overvalued? Here we are. It ended 2021 with no borrowings and £1.3 billion in cash and cash equivalents. They're saying that their rider satisfaction is about 85% globally, saying that they are satisfied or very satisfied working with Deliveroo, and that their attraction and retention rates remained robust during 2021, despite rising job vacancies across the economies. Now, rider satisfaction is something I'm interested in because I think Uber had some concerns because the drivers weren't happy doing it, and therefore there's a lot of concerns. I think even at one point unionization or something quite extreme. And so you want to have happy, I suppose, they're contractors and not real gig workers. And that would be great and integral really to the quality of the offering that you're providing. And so it's good to see that obviously things remain resilient, remain strong, and it's a positive sign. Is it something I would be buying? Well, it's a bit out of my understanding. It's not a product I really buy myself. It's a simple and easy to understand business, but I don't know about the logistics. I don't understand that. But I suppose if you've been doing Deliveroo style or you've been working for Deliveroo, you would have a better understanding of it. And then perhaps then you'd be like, okay, yeah, actually, I can really wrap my head around the business model, or maybe it's interesting. But then again, they're a recent IPO, so I've not looked at their valuation, but perhaps they are a bit more on the frothy side, especially as the name commands quite a brand at the moment as well, and competition I suppose is quite fierce as well, but one that is certainly interesting to me and I will continue to follow on the channel. Again, if you have any suggestions of companies you'd like me to follow in regularly, I like to go for the popular ones that can cover in the UK markets, please let me know and I'll add it to my list. As I say, comment down below. Furthermore, if you haven't already joined the Discord, definitely come and join and check that out. It's a great community, it's free, you can access everything you need to, and it just allows you to ask more personalized questions without having to rely on myself or obviously searching it on Google, for example. The next company is Fevertree Drinks. Now, you may or may not have heard of these. I've heard of it from being in the hospitality industry, and they're quite a premium brand. They look to be making these tonics and style of mixes for alcoholic like spirits, gins for instance. I suppose you could even say things like rums and vodkas, but again they're primarily I think targeting really gins more than anything. But they've got like soda, they've got tonics, they've got sparkling lime, rhubarb and raspberry tonic, etc. So you can see what kind of consumer they're going for, and they've said that they've maintained its #1 position in the UK retail mixer category with a 39.8% value share, so that's very impressive. And they are the brand to become so there's significant off-trade momentum in the US, with the brand growing to become the #1 ginger beer brand at retail in the US, as well as finishing the year as the #1 tonic brand at retail. So very promising. They have done very well. The UK has grown in revenue by about 15%, US has grown by 33%, and in total they've grown their revenue by about 23%. Their margins haven't grown as fast of a pace, while we've seen their adjusted EBITDA grow by about 11% in that time, but their net cash position has increased by 16% to £166.2 million. But this is a company that has always been trading at a premium, like significant premium. And I think if you look at their share price, which I'm not going to bring up now, I think in the last 5 years there was a point where you wouldn't have made any money on your investment just because of how priced up it really was. And so obviously there's mindfulness there. I originally, when I first started investing, I was very interested in, I can buy a quality stock at any valuation because it will hold itself together. And then you quickly realize that actually these stocks that do command a high premium on their valuation to earnings, you actually realize that, okay, well, this can obviously drop down with time. The quality of the business might be perceived as lower. The PE drops, and instantly, even if they're making more money and they've grown their revenue, if it's not as good as the valuation stipulates, then you end up losing money in that regard. So there is certainly a value to keeping an eye on valuations in the markets. And we've also got Ocado. Ocado, keeping it brief, they've seen their active customer numbers grow 31% year on year to 835,000. Very impressive in my opinion. They've seen their customer orders grow by 11.6%. That's very good. And their average basket size of £124. I'd love to compare that to like other supermarkets, other delivery apps. And I think when you compare it to like Boohoo's on about £44 average. I think that was in their presentation for the 6 months up in September, but I may actually be wrong there, and we don't know if this is obviously gross, net, or whatever in that regard. I'm guessing it's gross, but something to keep an eye on. They did say that revenue is down 5.7% in the quarter. that's concerning. But then again, obviously, this is the market environment. Inflation is strife. Ocado have always been a bit more on the premium side. And obviously, Marks and Spencer's, for example, they're using those kind of products which are a bit more on the pricier side. You might say, well, yeah, they should outlast inflation because they're more premium food goods and items, that they obviously can price that up and change the price. They have more pricing power per se. But again, obviously, that's going to represent a loss in sales somewhat. And if people are really tight for money, they're not going to keep shopping at Marks and Spencer's unless they have significant discretionary income. They might go, actually, you know what, I'll start shopping at Tesco. Actually, the people from Tesco think it's a bit too expensive. I'll go shop at Aldi and Lidl, for example. So definitely some changes in the market, but very interesting to follow in my opinion. And I think overall in the last week, stocks have been quite mad. It's seeing a lot of consolidation, a lot of movements, and a lot of volatility. And I think we should be very careful here. This could be a dead cat bounce. Shares could be going up for a bit, but then at the same time, who knows if they'll dramatically pull back if tensions rise in Eastern Europe. Hopefully, I would like to see people sort of overcome the fears of the conflict in Eastern Europe. Again, we can't obviously be sure of that, but when you don't care about it as much and it doesn't impact your investment strategy, then you can really focus on your holdings, buying more shares, and really consolidate those positions for the longer term, which is exactly what I'm doing, looking to earn as much money as possible to therefore grow my overall portfolio so that in the future I'll have a lot more money and I can end up retiring whenever I would like. Now, if you're interested in making £1,000 a month in dividend income, then click the card at the top right of the video. Thank you for watching. I'm Ozbourne Foreman. Have a fantastic weekend.